Good morning. Well, the dollar fell Friday against all its G10 counterparts and almost all emerging market currencies as well, after the August non-farm payrolls came in well below estimates. That caused investors to question whether the Fed would start tapering off its quantitative easing this month. The U.S. 10-year went over 3% in early trading in New York, but after the non-farm payrolls came out, it plunged to a low yield of 2.86% as thoughts of tapering receded. It later recovered about half the losses. Now, while there's been a lot of discussion about special factors in the employment data, nonetheless, the fact is that the 3-month moving average has moved down to 148,000 from 151,000 in July, and the Fed has set about 200,000 as the threshold for beginning to taper. I would note, though, that although the initial reaction to the data was harsh, that judgment gradually softened, and as I said, both the bond market and the Fed funds futures have gradually regained about half their losses. That suggests to me that the dollar, too, is likely to recover gradually this week, as the market realizes that the overall tone of the data is improving, and although this figure may have been disappointing, the Fed is still determined to start tapering sooner or later. I'd particularly point out the very weak reaction to the non-farm payrolls in dollar-yen, which didn't lose very much on the news and in fact was higher on the week. That suggests to me that the risk-taking sentiment in the market is still there, and that should support the dollar. In other news, China's exports rose more than expected in August. Meanwhile, inflation fell slightly in the month to 2.6% from 2.7%. Higher exports with no risk of inflation is really good news for the Chinese economy. It suggests sustainable, non-inflationary growth. And the news lifted both the Australian dollar and the New Zealand dollar. Also in Australia over the weekend, the Liberal National Coalition pushed out the incumbent Labour Party in a general election, but that doesn't seem to have been as big a factor in the FX market as higher than expected home loans in July. Last week, I reversed my call on the Australian dollar, and I'm now recommending a tactical long position in the currency based in part on this improving outlook for China. Long Aussie versus yen or versus the euro seems the best likelihood of profit to me. Activity today has been relatively quiet as there are no major indicators on today's calendar. Later today, we have U.S. consumer credit for July, forecast to rise by $12.6 billion, which is less than $13.8 billion in June. But with most of the U.S. consumer credit nowadays being student loans, this indicator is less important than it used to be. This is Marshall Giller, head of Global FX Strategy for IronFX, wishing you solid trading.